Let's also turn to the broader market here. Treasuries are reversing gains sparked by an escalation in the war between Russia and Ukraine, with yields now resuming their climb higher amid the sell-off taking hold since the election. Joining us now, we've got Nate Thooft, who is the Manulife Investment Management Chief Investment Officer and Senior Portfolio Manager. Great to have you here with us in studio.
It's great to be here.
Absolutely. So let's just kind of correlate the two together and the move that we're seeing in treasuries, especially coming off of what took place over the past few days with the ratcheting up of some of the geopolitical tension.
I think the action you've seen is pretty characteristic of risk sentiment, right? We have this broader worry that there's a potential for higher yields because of inflationary dynamics perhaps picking back up. There's uncertainty around future policy in the US. At the same time, it is reacting when it comes to geopolitical issues, and yields come down when there's a risk-off type of sentiment. So you're going to see more of this, I think, over the coming year. Our general view is that the risk-reward on the belly of the curve is actually pretty good. But the longer end of the curve, we do worry that there's some upside going into the future just because we're woefully underpricing term premium in the market. And so we think that there is opportunities in fixed income, particularly on the shorter end to the intermediate term. But the longer end, we do have some worries about higher rates in general. But at the same time, the action we're seeing in the fixed income market is pretty rational in our view when it comes to the reactions to geopolitical risk.
So what's your advice then to investors just given some of those longer term concerns?
Our view is when you think about asset allocation, and I'm an asset allocation guy, you got to think about the drivers in your portfolio that can serve as a ballast or as a downside mitigator when it comes to risk-off events. Fixed income will still serve that purpose, but we do worry that you're going to see more episodes like we saw in 2022 where fixed income correlates the wrong way with equities, as in they go down at the same time. So our argument is you need other diversifiers in portfolios, whether that's commodities as an example, parts of the private asset market when it comes to private credit and other things like that. We think there's other ways to introduce tools into your portfolio beyond just relying on long duration fixed income to serve as that downside protection.
On the other end of this too, when it is more of a risk-on appetite in the markets, you typically tend to see some of the safe haven commodities react in an alternative fashion. So where are the commodities that you would be looking to actually outperform even when there is a risk-on sentiment?
We do still like gold. Gold has been one area that we've had in our portfolios for some time. It's worked really well. We've seen a little bit of a pullback. We actually think this is an opportunity. I think realistically there is a 3,000 number on gold at some point in time in the next 12 months. Maybe we'll get there, maybe we won't, but I think we're trending in that direction. So gold is still a good idea, but I also don't think the market is pricing much when it comes to concerns in the oil and energy markets. And so we see some opportunity, even though there's concerns about China growth and other drivers of demand, we think the pricing just isn't pricing a lot in from the potential of geopolitical risk or upside to growth if we start to see recoveries around the globe.
What do you think that upside then looks like for crude specifically?
So I think crude at this stage obviously is not pricing a lot in from a geopolitical risk,
right.
But could you price in $5 or $10 of that? You certainly could. I don't think we're going to see oil over $100 anytime soon. I don't even think you'll see WTI over $80 necessarily. But if you can get oil back into the mid 70s, upper 70s, close to $80, I think that's a reasonable expectation given the drivers on both the demand side and the supply side that we see in the market.
Do you think there are any significant moves then that the oil market should be prepared for, even considering the geopolitical tensions that we started off the conversation with, but also from OPEC as it's kind of winding up and making its own decisions going into next year too?
Well, I think you're definitely going to still see the rhetoric around whether or not OPEC will, limit supplies or add supplies over the course of the coming years. But the reality is, I think generally speaking, OPEC would like to see slightly higher oil prices. I think generally speaking, the economy can handle oil prices that are $10 or $15 higher than current levels. And so if the economy continues to hum along as it has, and we start to see some recovery or at least better growth in other parts of the world like China, et cetera, you should see some natural upside in oil prices.
Nate Thooft, great to have you here on set with us this morning. Chief Investment Officer at Manulife Investment Management. Thanks so much.
Thank you.